Welcome to Iron Financial. This is the place where we help you forge a much stronger portfolio by cutting right through the market's weakness. Today, we are diving headfirst into the high-stakes, high-voltage world of AI infrastructure. We are putting Applied Digital, that's ticker APLD, directly under the microscope.
And you're not kidding when you say high stakes. I mean, this company is making an incredibly bold play. They want to build the physical backbone for the entire AI revolution, but, and this is a huge but, they are doing it with an absolute mountain of debt. So the real question we have to answer today, the one that matters, is whether they are actually forging a durable empire or if they're just taking a wild gamble with a whole lot of borrowed money.
That's the heart of it, exactly. So let's not waste any time. Let's dive in and start stress testing this entire structure.
And you know, this headline from Bar Chart just perfectly frames the battleground for the stock. It really lays it all out, doesn't it? It's a classic Wall Street story. You've got this rocket ship of revenue growth in one corner, and in the other, you're facing off against a dragon of mounting debt. So what we're doing today isn't just a simple analysis, it's a genuine stress test. We're here to see if the engine on this thing is powerful enough to actually escape the gravitational pull of all that leverage.
That's exactly right. We're going to examine the structural integrity of this company, we're going to kick the tires, check the foundation, and see if it can really withstand the immense pressure it's under. We're looking way past a single flashy earnings report to figure out if the entire business model is actually built to last, or if it's just a house of cards waiting for a gust of wind.
All right, to do this the right way, we need a blueprint. So here's the game plan. We're going to start with the macro tailwind, this massive AI infrastructure boom that's lifting all boats. Then, I'm going to build the bull case, piece by piece, focusing on the sheer, undeniable force of their revenue growth.
And then I get to take out my sledgehammer and start looking for the foundational cracks. That's the bear case. We are going to zero in on that massive debt load, what we're calling the $2.7 billion question.
Exactly. And from there, we'll see how Wall Street is handicapping this very risk with their own blueprint, before we bring it all together, weigh the evidence, and deliver our final iron verdict.
Okay, let's set the stage here, because the context is absolutely critical. This AI revolution, it isn't just happening in some abstract digital cloud. No, it's being built on the ground, with steel, with concrete, and with absolutely massive amounts of power. Every single AI model, every query you type, every single breakthrough, it all requires immense computational power. And that power has to be housed in highly specialized data centers. You see, this is the new gold rush, and companies like Applied Digital, they're not out there digging for gold. They're selling the picks and shovels. They are building the heavy-duty infrastructure, these AI factories, that the hyperscalers and the tech giants are absolutely desperate to get their hands on.
And look, don't just take my word for it. This quote is coming straight from the top, from the CEO, Wes Cummins. He is on the front lines of this thing, and he's telling us that demand isn't just strong, it's accelerating. And the word he uses, aggressive. That's the key right there. That word implies that the big tech players are in a frantic, almost desperate race to secure this capacity, and they simply cannot build it fast enough themselves. They need partners like APLD.
Okay, hold on. Of course, the CEO is going to say that it's literally his job to sell the story and paint the rosiest picture possible. But the real question is, can they actually meet that demand without completely collapsing under the weight of their own ambition? That's the powerful tailwind, sure, but we still need to talk about the serious turbulence it creates.
That's a fair point. A very fair point. But let's build this case from the ground up, starting with that demand backdrop. Let's start forging the bull case. And just like any strong structure, it has to start with a powerful, solid foundation. For APLD, that foundation is pure, unadulterated top-line growth. I mean, the numbers we're about to see here are absolutely staggering, and they form the first massive pillar of the argument that this could be a generational opportunity to invest in the physical build-out of AI. So let's break down exactly how strong this growth really is.
The starting point, the number you have to burn into your brain, is the Q3 revenue figure, $126.6 million. Now, you know, on Wall Street, context is everything. The consensus expectation from the analysts, the professional forecasters, was around $76.5 million. APLD didn't just beat that estimate, they obliterated it. They blew past it by over $50 million. This wasn't some minor outperformance, this was a statement. It signals to the entire market that their ability to generate revenue is accelerating faster than even the most optimistic models out there had predicted. This is the kind of explosive power that really gets the market's attention.
And that incredible Q3 beat, it wasn't a fluke, it wasn't a one-time thing. Just look at the year-over-year comparison on this chart. We're talking about 139% growth. They more than doubled their revenue from the exact same quarter last year.
This isn't just growth, this is hypergrowth, and it's being fueled by their new high-performance computing segment finally coming online. Their massive Polaris Forge 1 data center became fully operational, and you can see the immediate dramatic impact on the top line. This is the bull thesis playing out in real time.
Okay, hypergrowth is great. Nobody is going to debate that. But listen, anyone can grow the top line if they're willing to spend enough money to do it. The real question, the one that smart investors ask, is, are they making any money doing it? Is this profitable growth? Or are they just lighting cash on fire to make the quarterly numbers look good? That is the core of the bearish concern, and I promise we will address it head-on. But first, if that quarterly revenue is the foundation, then this number, $16 billion, is the skyscraper they plan to build on top of it. This is the total value of their contracted lease revenue. And let me be crystal clear about what that means. This isn't some speculative, pie-in-the-sky future business. This is revenue that is locked in through long-term leases with absolute heavyweight clients like CoreWeave and other investment-grade hyperscalers. The bulls see this as a predictable, almost utility-like annuity stream that's going to stretch out for decades. The argument is beautifully simple. They've already sold all the office space. Now they just have to finish building the skyscraper. Just have to build it. Man, you make that sound so deceptively simple. But as we're about to see, that's exactly where all the risk is hiding. A contract is only as good as the company's ability to deliver on it without going completely broke in the process.
Okay, I'll give it to you. That's a powerful bull case. A mountain of revenue, a massive backlog of contracts. I get the appeal, I really do. But here at Iron Financial, we forge strong portfolios by stress testing the narrative, not by just accepting it. So it's my turn. Let's take out the sledgehammer and start looking for the foundational cracks. Because I promise you, underneath that gleaming, shiny revenue figure, there are some very serious questions about profitability and the fundamental stability of the entire structure. A skyscraper is only as strong as its foundation, so let's start drilling down.
And the very first crack appears right here, in this tale of two different earnings numbers. On the left, you have the figure the company really wants you to see, adjusted earnings per share of a positive 9 cents. A big beat against estimates. It looks fantastic on the surface. But then, you look to the right and you have the GAAP number. That's generally accepted accounting principles, the one with fewer tricks and accounting adjustments, and it tells a very, very different story. A loss of 36 cents per share. A huge miss. So which is it? Is the company actually profitable, or are they using financial engineering to hide the truth? I know which number I trust more.
And that ugly GAAP number leads us directly to this staggering figure, a GAAP net loss of over $100 million in one single quarter. Let that sink in for a moment. While they were busy generating a record $126 million in revenue, they managed to burn through even more. And the trend here is getting worse, not better. The loss deepened by a shocking 179% year over year. So I have to ask the question, is this growth at any cost? Are they building a business, or are they just building a massive cash-burning machine? This, right here, is the dark side of that hypergrowth story.
The losses on the income statement are definitely worrying, but the real stress test, the one that can truly break a company, always happens on the balance sheet. This is where we separate the hype from the cold, hard reality. The revenue growth and the massive construction projects are impressive, sure, but we have to ask the single most important question of all.
What is fueling all of this construction? I mean, that incredible expansion, the groundbreaking on brand new campuses, the rapid deployment of these so-called AI factories, none of that comes cheap. It requires a colossal, almost unimaginable amount of capital. And for Applied Digital, that fuel has a name: debt. This is the single biggest risk factor hanging over this company, and it's the central focus of the entire bear case.
And here is the number that should make any bull just pause and take a very deep breath. $2.7 billion. That is the total debt sitting on the company's books. This isn't just leverage, it is a mountain of it. They recently completed a massive $2.15 billion private offering of senior secured notes just to fund the construction of one single campus. This puts immense, unrelenting pressure on them. They are no longer just a data center operator, they're a highly leveraged construction company that is racing against the clock. Every single dollar of that $16 billion in contracted revenue is now completely beholden to their ability to manage this debt and execute absolutely flawlessly.
And this, right here, this is the knockout punch from the bear case. That $16 billion backlog the analyst was so excited about, well, it's not bulletproof. This quote from bar chart reveals the critical contingency, the fine print. CoreWeave, their largest customer and the source of a huge chunk of that future revenue, can walk away. penalty-free, if Applied Digital misses its delivery targets. So the entire investment thesis, the whole story, hinges on construction timelines. Any delay, whether it's because of supply chains, labor issues, or financing problems, doesn't just push out revenue, it could make it evaporate entirely. This is maximum execution risk. The foundation isn't just built on debt, it's built on debt that's tied to a ticking clock.
Okay, the bear case is severe. A mountain of debt, widening losses, extreme execution risk. You've made your point, and it's a strong one. So, is this an open and shut case, a clear trap for unwary investors? Not so fast. We have to look at what the professionals are saying. The analysts on Wall Street who get paid to model these very risks, well, they have a completely different blueprint, and it is overwhelmingly bullish. They've seen the debt, they've seen the GAAP losses, and they are still pounding the table, telling people to buy. Let's see why. Just look at the analyst consensus on this chart. It's a sea of green. It's not a mixed bag at all. Out of 14 analysts covering the stock, 12 rate it a strong buy. There's one moderate buy and only a single hold. There are 0 sell ratings. This is an absolutely incredible display of conviction from the professional community. What this tells us is that the pros have stress-tested the balance sheet, they've modeled the construction timelines, and they've concluded that the potential reward far outweighs the very evident risks. They believe the company can and will execute.
Or it tells us that Wall Street analysts can suffer from groupthink just like everyone else. They see the same shiny revenue numbers that you do. They get caught up in the hype. Let's see what kind of price they're actually putting on all that optimism.
And this number right here is the reward they see for taking on that risk. The average analyst price target is over $49 a share. From its recent price, that represents a potential 95% upside. Even the lowest, most pessimistic target on the street still implies a 43% gain. Wall Street is essentially placing a massive bet that if APLD can successfully navigate this high-wire act of construction and debt management, the payoff for investors who get in now will be absolutely enormous. So what Wall Street is really saying is if, and let's be honest, that is a very big if, APLD can pull this off, the payoff will be enormous. They're betting the company can somehow convert that massive debt into an even more massive stream of revenue. It is the very definition of a high-risk, high-reward bet.
So, there we have it. 2 completely opposing forces pushing and pulling on this stock. We have a bull case that is built on explosive, tangible revenue growth and a massive contracted backlog. And we have a bear case that's centered on what looks like a fragile foundation of massive debt, real GAAP losses, and what seems to be life-or-death execution risk. It's time to bring it all together. Let's weigh all the evidence and render the iron verdict. How should an investor like you analyze this high-stakes standoff? All right, let's break it down factor by factor. First up, revenue growth. The structural strength is undeniable, 139% year-over-year growth and a monster beat.
But the potential weakness? We still don't know the ultimate cost of that growth, and we have no idea if it's even sustainable.
Second, profitability. The bull points to the positive adjusted EBITDA and a solid beat on adjusted EPS, arguing there's underlying operational strength.
While the bear points to that deep and widening GAAP net loss as a major red flag that you simply cannot ignore.
Third, the balance sheet. The strength here is that $16 billion in contracted revenue from very creditworthy tenants.
And the weakness, and it's a huge one, is the massive $2.7 billion in debt that's funding this whole thing.
Finally, and this is the most important one, contract execution. The bull sees them breaking ground and actively building, turning those contracts into cold, hard cash.
And the bear sees that penalty-free walkaway clause as an existential threat hanging over every single deadline. The entire story, the whole thesis, comes down to that last line: can they build on time and on budget?
And that leaves us with the final question, the one that you, the investor, must answer for yourself. Applied Digital is, without a doubt, building a skyscraper, a massive potential revenue engine for the AI age. But the question remains, is the foundation of debt and complex execution risk strong enough to actually support that ambition? The potential upside is immense if they succeed, absolutely. But the entire structure could come crashing down if they miss a single critical deadline. Your job as an investor is to decide if the blueprint is sound. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.